This is Retirement Keys with Anthony Kangemi from Crescent City Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Anthony provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Retirement Keys with your host, Anthony Kangemi.
Welcome to another show of Retirement Keys. My name's Anthony Kangemi with Crescent City Retirement Group, and we are so happy you're with us this morning. We have a great show planned for you today. Before we get started, I'd like to introduce you to our fabulous co-host, which now, not only on audio, but video as well. And so we couldn't do this show without Tony. We really couldn't. But Tony Shore has been really just such an integral part of our show. So, Tony, thank you so much for joining us this morning.
Yeah, Anthony, great to be here. Excited about the show today. I can't wait. It's going to be a good one. We got a great topic, and everybody's excited this time of year, Anthony, because, we're headed into the holidays. We've got Thanksgiving and Christmas and New Year's coming up, and people need to know what they need to get done financially before the end of the year, they still can, they have time to maybe affect this year's taxes and future taxes as well. But before we get into that, I've been really crazy busy myself. I don't know if mid-November is too early, but I've got the Christmas lights up. I did that this weekend. Yeah.
Okay.
Put them up on the outside of my house. We've got a big blow-up Snoopy and Woodstock Christmas thing in our yard. It's crazy.
That's great.
Yeah.
I saw a picture or something, a little cartoon animation, and it was a turkey sitting on top of Santa Claus, and the turkey's saying, "Wait your turn." Santa. Actually, it said something else, but I won't say that.
Well, sure.
But anyway, wait your turn. So turkey wants us to wait till we get past Thanksgiving, but. You're right. I mean, everywhere you go, there's, Christmas decorations in all the stores. People get ramped up early. People love the season.
Yeah, and I've heard Christmas music on the radio already. So, but this year, I think Thanksgiving is so late in the month, right?
Yeah.
It's at almost the very end of the month. So I think people are taking advantage of that. Before Halloween is too early.
Well, I would say, yeah.
But hey, Halloween is
I
past.
have clients, Tony. I have actually folks that I know over the years that do just that. They just love the season, which we all, I certainly do. And they get their decorations up, they get the tree up. Now, is your tree up, Tony?
No, the tree is not up. We have a dog and 3 cats, and because we have 3 cats, we can no longer have nice things in our house. That's the problem. The tree cannot happen in the house. They will knock it over, play with the ornaments, knock it down. So we have an upstairs deck out our sliding glass door in our upstairs that's right off our kitchen and living room with our big window. You can see the deck. So I put a live tree out on the deck. And we decorate that out there with lights. So all our neighbors can see it driving down the road, and we can look out our back deck and see our tree out there. Cats can't get at it. And people say, well, doesn't it die out there? Don't you need? No, I just, once in a while we go pour some hot water in there if it's frozen, because up here in Minnesota,
right,
it freezes, but it's actually does really well out there, lasts a long time.
And I imagine when it snows, it really just, it just probably
beautiful.
looks.
Yeah, the light shine through the snow.
You and your wife curl up on the couch and watch the Hallmark movies as well, Tony?
Yeah, I will be forced to watch a few Hallmark movies. That's they all have the same plot, but I'll probably squeeze in a couple. You know me, I force my wife every year to watch Christmas Vacation and Christmas Story, and then in return, I watch a couple of the Christmas Hallmark movies. So we trade off.
Well, very good, man. Well, that sounds great. I'd like to get up there sometime.
Oh, yeah. You got to come out to Stillwater. It's beautiful. We live on the river east of the Twin Cities, and it borders Wisconsin. Beautiful, beautiful river, an old logging community. Stillwater is the oldest established town in Minnesota. It was the first town to be established in Minnesota.
Okay,
wow. They call it the birthplace. So, but let's get, we digress. We're talking about year-end planning, and you have a great document, and we've touched on this in years past, and you're always updating it. So this is the time of year. January 1st is coming strong. We're going to be into the new year before you know it. What's the first step we need to do in year-end planning?
Absolutely, Tony. So you're right. We have an updated PDF of the year-end planning points that we'll make on the show, which we certainly want to make available to all of our show listeners, which we'll send to. But we have some top planning tips for you this morning. The first one on the list is make sure you've taken your required minimum distributions for the year. Failing to take your RMDs can result in a pretty big penalty. So, as you know, Tony, depending on when you were born, you could have required minimum distributions from your retirement accounts that frankly are retired, that are required for you to take, right? So it could be 70 and a half, could have been your target date. It could have been 72. It could have been 73. It could also be all the way out to 75. So it really just depends on when you were born. But the key here, Tony, is if you are required to take RMDs or required minimum distributions, it has to be done before December 31st, or there's a penalty waiting on you.
Well, Anthony, that's a great point. I mean, I know that you and your staff there at Crescent City work hard to make sure that your clients don't miss their required minimum distributions, because doing that can be costly. There are penalties, and it can put you in a bad situation. But you have to make sure, if you have certain types of accounts like IRAs, a traditional IRA, you have to take money out of that account. Now the age is 73, and then it'll be 75. But once you're in your 70s, you got to make sure you talk to a financial advisor about that, right?
Absolutely, Tony. Absolutely. And, when we're developing retirement plans as a whole, even if you are not required to take any RMDs at this time, it's as far as a distribution strategy and trying to be tax efficient, Tony, which is really the key. You don't want to see that when RMDs are required, a big spike in your income. What you hope to do is take the distributions over time where you can maintain your tax bracket, so you don't ultimately jump into higher brackets later on.
Right.
So really that distribution strategy you should be thinking about that, frankly, long before RMDs even come into play. But ultimately, as you say, if you're in your 70s, we really need to make sure that if you are required to take some distribution, that it gets done, because again, there is a penalty if not done correctly.
Sure. Yeah, and you want to definitely avoid that. So that's a big part of year-end planning, especially once you're in retirement. Make sure those RMDs or required minimum distributions are taken care of. Make sure you know what's going on with those. That is huge. So what's next on the checklist?
Yeah, so the next one, Tony, is going to be reviewing your tax withholding. So if you've, had a big event this year, like a wedding or a divorce or maybe you receive some additional income, if you will, from maybe some bonds that have come due, or you might have sold a piece of property. Whatever the case is, it's always good to, at the end of the year, to look at how your income is going to ultimately play out for that year and what the withholding has been. You want to make sure that you've got enough tax withholding that has gone in, so you don't ultimately get a penalty for not having as much in as needed to be. I know a lot of our clients, we do the tax withholding on a lot of those distributions, but depending on if there's an additional event that may have taken place that year, I mean, at the end of it, you just want to do, and we do a lot of this, at the end of the year with our clients, certainly, we are looking at what their income looked like for the year and how much was withheld in taxes. We want to make sure the year doesn't close where they didn't have the appropriate amount of taxes put in for that particular year.
Sure. Yeah, and that makes perfect sense. Obviously, your taxes are the biggest thing for year-end planning because you're on a deadline, right?
Yes,
a lot of these accounts, you have a tax deadline. Oh, maybe if I make a bigger contribution, if you're not yet in retirement, we're talking about making contributions into those accounts to get tax deferment this year. Maybe we're talking about taking advantage of lower taxes and converting to a Roth, right?
Absolutely. Absolutely.
That's all part of it. And I think that's great. So at the end, this time of year is a busy one for financial planners like yourself because everybody's wanting to do these things and check to see where they're at, especially as we head into the spending season, as it's called, with Christmas and the holidays. People are traveling, they're buying gifts, they're spending money. So it is good to take an overall look at your financial situation and work with somebody like yourself, a financial professional. I know you and your staff do such a good job for your clients, and you'd love to hear from our listeners out there. What's another thing we should review or look at before the end of the year?
So the third thing, Tony, is going to be reviewing your insurance policies, going over your homeowners, your auto, your life insurance policies to ensure that they're going to continue to meet your needs in the future and possibly find better deals. And so we do this religiously, Tony. A lot of times, especially down here, Tony, with the homeowners insurance situation, a lot of people have experienced with these last couple of storms that have come through here, pretty large rate increases in their homeowners insurance. So that's always something to look at and to compare. Life insurance policies, Tony, a lot of times, people will be in policies that aren't being funded correctly, and all of a sudden they'll get a big sticker shock surprise. The insurance company will send them a letter and say,
Great.
You've got to put all kinds of money in this thing, or maybe it was a term policy that it's going to be expiring or terming out, if you will. So really just taking a good inventory of all of your insurance policies at the end of the year is always another really good practice.
Yeah, that's one I wouldn't have thought of, actually, is looking at my insurance policies, but I'm glad you mentioned that. My wife and I should take a look at where we're at with some of those. That's a great idea. And, end of the year planning, it's not that tough, but a lot of these things people just don't think about. And that's why I really encourage everyone out there to give your office a call, set up a consultation to look at your financial picture before the end of the year. There might be some things you can do, costly mistakes you could avoid, or things you could do to really improve your situation moving forward. I think that's huge. Whether you're near retirement or in retirement, this is all very important. So we've talked about required minimum distributions, tax withholdings from your retirement income. What about in insurance policies? What's next?
So, the next on the list, Tony, is going to be looking at your charitable contributions.
Sure.
So making a list of all the donations you've made throughout the year, that you're going to want to utilize for tax season. So really just take an inventory of those charitable contributions. Now, as you know, Tony, if you're in a situation where you're taking the standard deduction, then a lot of times those charitable contributions are not going to be used in your tax return if you're taking the standard deduction. And as you know, the standard deduction with the Tax Cuts and Jobs Act that was passed, they've gone up significantly. But for this point, certainly getting a list of all of your charitable contributions is going to be key to be able to determine whether you're going to use these contributions or you're going to use the standard deduction. So it's really just information that's going to be needed to determine what's going to be the best filing strategy. And let me just add on this one here, Tony, since we talked already about required minimum distributions. If we have a client who is taking the standard deduction, then these charitable contributions, if they're using the standard deduction, Tony, really doesn't help them as it relates to reducing their income on their tax return, right? Because they're taking the standard deduction in this case. Well, what I wanted to mention is what's called a qualified charitable distribution, where people that are taking required minimum distributions or RMDs can do a qualified charitable distribution directly to the charity of their choice that qualifies, of course, but then the income that they would have had to report on their required minimum distribution, right, goes straight to the charity. So it becomes a tax-free distribution directly to that charity. So those are called QCDs, or qualified charitable distributions. So if you are taking required minimum distributions from your IRA and you're simply using the standard deduction and you are giving to a charity, then those qualified charitable distributions can not only offset that off of your income, so you're not paying taxes on those RMDs, but then the charity itself is receiving that money tax-free. So, not to get too far into the weeds, but looking at your charitable distributions, especially if you're taking required minimum distributions, RMDs, from your qualified plans, there's a planning opportunity there, Tony, for everybody involved.
Yeah. Wow. Okay. So that can make a big difference. And they go hand in hand, those required minimum distributions and then those qualified charitable distributions.
Correct.
So if somebody doesn't need their RMD, and my parents actually made this mistake, and I learned from it after working with you, when they first hit their 70s, and back then it was 71 and a half, they had to take RMDs from their IRA, but they were also writing checks out to their church a couple times a year, right out of their checking account. And,
right.
They 10%, they were big tithers to their church and really wanted to support the local church. Well, they gave a lot of their money to the church, but it was after tax money. So they paid taxes on that money, then wrote a check and paid it to the church. And when they turned 70 and a half, they could have taken those required minimum distributions or done it from their IRA directly to the church and avoided paying tax on that money. So it's a win-win.
Yeah, and let me just say, Tony, it wouldn't have to be all of the RMDs. So it would just be the money that they would have normally given to the church anyway.
Sure.
So if they were going to give $5,000 to the church and their RMD was $10,000, they could still just simply give the $5,000 to the church as they always did. But if you go look at their tax return, Tony, and they're taking the standard deduction, then the $5,000 that they're given to the church, they're not getting a write-off on that,
right?
Because you don't get the charitable contribution and the standard deduction. So they're already taking the standard deduction. They're getting the $10,000 in this example from their RMD. Like you say, they're paying taxes on the $10,000, writing a $5,000 check to the church. They're not getting a write-off of the $5,000, right? But if they gave the same $5,000 to to the church, but did it straight from the IRA that was going to be an RMD to them and go straight to the church, that satisfies their RMD for that $5,000, but it's not going to hit their tax return.
Right.
So they don't pay taxes on that $5,000. So they win and the church wins, right?
Right.
But again, you have to be in RMD territory. You have to use required minimum distribution to do those charitable contributions. So,
okay.
Anyway, yeah. Tony, look, at the end of the year, there's so much that can be done to really improve on a situation, or at least at the very least, make sure that nothing is missing.
Right. And that's a huge one. Now, I had brought this up earlier, but another end of the year planning tip I know that's on your list is Roth conversions, right? That's something people can look at.
Absolutely, Tony. So let me give you just a quick example here. Right now, and of course, everybody's tax situation is different depending on how they file. But just as an example, if you're married filing jointly and you're in retirement with Social Security and maybe some IRA income or maybe a pension or annuity income, whatever it might be. And let's just assume for a minute that your total income coming in the door is, I'm gonna just use as an example of $100,000. Okay, you're drawing $100,000 between Social Security and other income. Well, in the 12% bracket, Tony, as a married filing joint taxpayer, you can go up to about 123,000 and still maintain the 12% bracket. The next bracket from 12 goes to 22. Okay, so that's a pretty big jump from 12 to 22.
Yeah.
So with these Roth, and I'm just using this one as an example, but in these Roth conversions, Tony, if they still have room in that bracket, so in my example here, we're going to say that we had 23,000 left in the 12% bracket. Well, in your retirement money, we know you have to pay taxes on that money, correctly? The question isn't, do I have to pay tax on the money? The question is, at what rate? So the Roth conversion is just simply filling up the bracket, if you will, taking the 23,000 in this example, converting it over to the Roth, paying the 12% to Uncle Sam, getting the money in the Roth, filling up that bracket, which in this example, that's a very efficient bracket, right?
Sure.
Utilizing that additional room in that bracket, getting the taxes paid on it, getting it into the Roth. And then, as you know, Tony, forever and ever, that money's going to grow tax-free, not only for your client, but also for their heirs. So Roth conversions are big, Tony.
Huge.
Yes, sir.
Yeah. Well, that's great. And I know we've done entire shows on Roths and Roth conversions. And Anthony, you always tell me you got to have money in a tax-free bucket in retirement. You need to make sure you've got tax-free options in retirement, so it's not all taxable, right?
Correct.
Yeah.
Absolutely.
Yeah, that's huge. And for that, you have Roth IRAs, Roth 401ks, cash value life insurance. Those are all tax-free options for retirement that might work for some people, but not everybody's going to qualify for those things, and everybody's situation is different, which is why before you make this decision, you got to pick up the phone, give Crescent City a call. Anthony, I know you love hearing from our listeners out there. Now, what else is on this year-end planning checklist that you have?
So, all right. So number 7 on the checklist, retirement contributions. Review the pre-tax contributions that have you taken out of each paycheck. Consider increasing the contributions. So this is an example, Tony, of somebody that maybe drawing some additional income. Maybe their income, they're still working. They have some additional earned income, and they're trying to offset some of that income. So there are accounts where IRAs, if they're self-employed, maybe some self-employed income. There are certainly SEP IRAs where people can make these contributions to lower their tax liability. In other words, lower the income that they have to pay taxes on by making contributions in a qualified plan.
Well, hey, we're almost out of time for today's show, but the most important thing on the list, we're saving the best for last, is before the end of the year, meet with your financial services professional. And if you don't have one, hey, I'm not going to name names, but I know a guy, Anthony Kinjemi, Crescent City. They can call you. What's that phone number where our listeners can call for a no-charge, no-obligation consultation?
Absolutely. So thank you so much for joining us. We hope that this has been a helpful show today. We do have the list, the planning ahead, stay on track, end of the year checklist that we want to send to you. Just simply pick up the phone and call us at 504-828-2171 or go to crescentcityretirement.com and ask for your end of the year planning checklist.
Awesome. Great show today, Anthony. A lot of great tips and information for year-end planning. Listeners, thanks for tuning in. That does it for today's episode of Retirement Keys with our host, Anthony Kinjemi. Thank you for listening to Retirement Keys. Don't pay too much for taxes or retire without a sound income plan. For more information, please contact Anthony Kinjemi at Crescent City Retirement Group. Call 504-828-2171 or visit the website at crescentcityretirement.com.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.